TheoTrade. This is Don Kaufman. It's May 28th, 2022, doing the TheoTrade weekend update here on a Saturday morning. Welcome to your Memorial Day weekend. Lots to obviously discuss in this kind of weekend update. We're going to be extremely forward looking. I guess the primary question, though, is this really kind of the quintessential bear market, rip your face off rally right now? One of the things, though, that I'm going to display in this weekend's update is there's just a huge amount of just kind of chaos and conflict within the tape, and everything from Skew to, if you look at the volatility futures like I do, and it's just in a kind of a huge, wild at this point contango, where you would think after all the volatility that we've seen, maybe a flat vol skew or possibly even backwardation. Nevertheless, we're still in a huge contango. Skew flattens out. The VVIX is down in the dumpster over here. Again, I'm going to show you a lot of areas of conflict inside of the tape, but then much more specifically, we're going to discuss in detail two separate gravity points in the S&P futures, and those levels specifically in the S&P futures are absolutely critical to the forward future of the entire marketplace. And again, I'll describe those like breaking above, and I'll give you a quick example here of 4211 would actually be wildly bullish for the S&Ps. Breaking below 49.31 is just downright and hideously bearish, and everything in between, well, that's actually in large part where we expect us to trade. But with that, let's get right down to it and explain in a bit more detail here in this weekend's update. All right, let's get down to it. Late this week, we see an explosive rally coming off of the Fed minutes. Interestingly and ironically, the last significant rally that we saw in this marketplace was off of the FOMC meeting itself, and I'm actually highlighting that on your screen present time. This one, though, there was a bit of a rally early on in the week, but the Fed minutes just sparked and unleashed, if you will, this monstrous, what started as a short covering rally. So that is ultimately what sparked the rally, is some short covering. And when we start talking about the idea of short covering, I mean, listen, we haven't had but a handful of upticks for weeks. As we all know, we had 7 down weeks followed by just this blistering move to the upside. And that's one of the reasons I am calling it kind of that quintessential bear market rally. Now, anytime there's a bear market rally, can it turn into more? Yeah, absolutely. Market might be able to get its groove back under it, but that is expressly why we're going to discuss some very key levels in, again, this weekend's update. So again, some short covering turns into some real buy side activity. And one of the most interesting things I think about some of this wild buy side that we saw, I mean, look at the S&Ps. This is an intraday, 1 day, 1 minute chart. And the reason I'm displaying this, because again, it was just absolutely relentless, move to the upside. And I think what a lot of us are kind of questioning is, can it all be short covering? Nah, I mean, there's some real buyers, but what people have to understand, okay, about a Friday afternoon kind of rally like this coming into a holiday, weekend, is that it's predominantly hedging activity. It's not just, some short covering probably sparked the rally. Unequivocally, it did. But then when we start to think about it, like, who would want to buy it, with everything that's gone on? And the truth be told, market making firms have to turn around and buy. You start with covering some shorts, okay? And those shorts, as you cover them, and again, a lot of people get lost in I think the minutia of what goes on in the market making side of the business, but it's important to understand this. So what is short covering? Okay, short covering is buying. So if you turn around and you buy because you're covering your shorts, right? So you're initially short. How do you cover the short? By buying. So you turn around and buy. That buying actually leads to a little bit of a spark to the upside, especially on a Friday. Okay, big market making firms, proprietary, trading firms, they're going to have a tremendous amount of gamma risk because the options themselves are expiring. So if you take a look at SPX options, okay, a ton of SPX options are obviously going to expire on any given Friday. In fact, when you start to look at the SPX, and we will look at the SPX, let's bring up the mother of all products, take a quick look at option statistics. Don't worry, it only did 5 times the norm. It did almost 2.43 million contracts. That's just the spider or the SPX. Bring up the spiders. Point I want to make over here: the spiders did what? 7.7 million contracts. Think about this. The SPX plus the spiders already did 10 million contracts. The entire marketplace only traded 45 million contracts yesterday. So you get this rally that is sparked, ultimately by market making firms and gamma risk. So they're short covering, yes, but from there it actually lights on fire and we rip because a lot of trading firms are actually caught with negative gamma. The easier way to describe this is as we go up, trading firms get more negative delta. If you're negative delta, how do you offset it? With positive delta. It's just an equation. How do you get positive delta? You buy, again, buy ES futures. It's just a critical thing to understand. So when you look at this and you're like, maybe the market's got its groove back, at this point in time, might I suggest, to me, none of this is real buy side. And then everybody turns around and they go, well, then how did Apple rally so much? How did Amazon? Because it's statistical arbitrage, and what that basically means, if the futures move up, so goes the marketplace. Otherwise, there'd be inefficiency. Does that make sense to everybody? Because again, it's so critical to understand that everything that you do in this marketplace is kind of tied together. If you buy the futures, you got to buy all the stocks in there, and this is like complete and total correlation to the upside. All right, but the move that we just saw was 2 times the expected move. Let's go to the SPX, and you can see that little like highlighted. Here's the bottom line of what happened and really transpired throughout the course of the week, because this is statistically viable, right? We started the week right around 3,900. That's what that central line on the screen happens to be. Where did we end the week? 4158. So let's just do some quick math over here. What do you got? Let's get crazy. Let's actually call it exactly what it is. About a 260 point SPX rally. The SPX was expecting, about $126 move. So what do we in fact have? Almost precisely a 2 deviation move to the button, people. It's pretty cool, isn't it? So one of the things that you want to gather from this is 2 times the expected move. Do you realize that during the entire bout of sell side activity, we didn't see any 2 deviation moves to the downside? We did not, according to weekly expected moves. That is, if this weekly expected move, which it was $126, there was no 2x to the downside. We got crazy a couple of weeks to the downside, but if you look at some of the breaches to the downside, they were negligible. Markets actually remained rather efficient to the downside. The inefficiency just came to the upside. To me, that's actually one of the hallmarks, if you will, of, again, that marketplace that just, exploded back onto the scene. By the way, early on in the year, there was a precipitous drop to the downside. That was a 2 deviation move. The interesting irony, if you don't recall this, but back again in the rally that we saw mid-March, you also had a blistering move to the upside, and there it is. I wanted to show you this simply because, again, it's one of the hallmarks of what I would term as a bear market rally at this point in time. Now, bear market rallies, of course, can turn into something more. Let's talk about more. So, short spark it. Did the market really get its groove back? No, it's just hedging activity. To me, there's absolutely no real buyers. 2 times the expected move. Bear market rallies are absolutely violent. This is part of the violence. That's exactly why I just labeled it and showed you actually previous, expected moves. But down to real business, let's actually identify some specific levels. We have 2 levels that are just absolutely pivotal in this marketplace. The first one up top over here is 42.11. Down below, again, is 39.31. If you do not have those marked on your screens for the S&P futures, you're doing yourself a huge, huge disservice at this point in time. The central place for trade in the last 2 weeks was all the way down here at 39.31. It's what we term a gravity point, where the marketplace is literally sucked to. Another one, that we had picked up on quite some time ago was actually the 42.11, and 42.11 carried massive weight for weeks, people. For more than weeks. I should even knock this back to, watch this, 180 day. This is 180 day. 4 hour, you will see there's just wicked reactionary lows into that 42.11. Almost unequivocally, it's where we're headed back to right now. Now, if we start getting above 42.11, again, above 42.11, I'll actually, hey, there's some real buy side activity. We could have a clean shot all the way up, even into the 4,400 or even 4,500. Okay, you cannot discount that. One thing I want to give you a good feel for on this weekend's update, I'm not going to sit here and try to handicap every single move this market's going to make, because I'll tell you what, we're still in the midst of, as I call it, it's conflict and chaos everywhere in the tape. So don't try to handicap what you think we're going to do. You just got to come up with levels and say like, okay, so the first one, the marquee level would be like 42.11. Now, just because if we cross above it for a brief and fleeting moment, don't get all kinds of like, this is bullish, like we can cross through it, overextend and then rip right back to it. I would suggest that we're probably going to rest right at that 42.11, kind of reassess risk from that point, maybe reverse back down, but again, remains to be seen. This is a highly event-driven marketplace. The more event-driven we get, the more susceptible the marketplace is to just, as I said, kind of chaos out there. There's no directional feel from a day-to-day basis. Doesn't matter what you think, what you know. Oh, we were in oversold territory, as I said last weekend. So cliche, but now, of course, people are like, but look, the rally came. Of course, everybody's been looking for the rally. So the rally comes, but the rally can actually persist for a considerable period of time, or it can just drop right out and that's, it's over and done with. Again, we have seen in the beginning of this bear marketplace, all right, a rally that legit lasted for over 2 weeks, okay, followed by some of the most hideous sell side. Just don't get roped right back into this rally here. If you want to be bullish, that's fine, be bullish. Buy out of the money call spreads, get crazy with it. I don't care, but do not extend yourself into stock positions thinking that all is clear and all is well. Use spreads where possible. It's also really, really apparent that both NVIDIA and Costco kind of got caught up in the rally. I found this interesting because, as I said to you, NVIDIA was going to dictate order flow for the remainder of the week, and I said that literally on Wednesday night. Couldn't have been more truth to that statement. They got caught up in it, and I say they got caught up in it. If you missed like NVIDIA, this one's actually well worth describing. After their earnings announcement, check this out, after the earnings announcement, the stock was actually down massively. And when I say it got caught up in the order flow, but NVIDIA was actually leading in here. It was starting to rally in pre-market and exploded in the first hour of trade to the upside, kind of leading markets. The other interesting one was unequivocally Costco. The reason Costco was so interesting, look at this on a 1 day, 1 minute. Okay, out of the gate, this is one that was, again, it was down. It was down after the earnings announcement pretty considerably, right? Out of the gate, flies to the upside, order flow explodes in the S&Ps, and we're off to the races again. So it doesn't even matter what earnings are anymore. It's about order flow, and that's something I always stress. All right, so let me give you a little bit of that conflict in the tape. One of the first things I wanted to start with is Skew. Okay, Skew is still completely and totally perplexing at this point. Skew is inherently low, and what it to me it means is kind of lack of hedging, and that is a lot of trading firms aren't per se going out there and loading up on puts. And what kind of confirms that is VVIX. Okay, that's the volatility index. If you look at VVIX right here, right now, one thing that this one sits with me. It is a lack of interest in VIX options. But I went over and I looked at VIX options because obviously we just looked at SPX and SPX trading almost 2.5 million options. But I looked over at VIX and VIX did clear up to 800,000 contracts here. And that's almost 3 times the norm. Lots of call activity, lots of put activity. But the crazy thing is VVIX, which is the volatility of the volatility index. Okay. And again, this cannot be overstated. The VVIX, that is the lowest print. This week is the lowest print since the onset of COVID. So all of a sudden, hedging activity inside of VIX has ceases to exist. SPX. Okay, forget about the SPX itself. The Skew, which is the out of the money puts versus the out of the money calls, Skew is just off. Could it be that people are literally just buying calls in the SPX waiting for the rally over here, or they're selling puts? Again, if you take a look at the statistics, there is one thing that's kind of striking. Call sizzle and put sizzle, okay, are almost identical, which means nobody's trading calls heavily or puts heavily versus the previous 5 days. So the only thing I can discern from this is that, like, literally, there's just not a lot of anxiety to the downside right now. Believe me, that actually gives me an anxiety to the downside because I don't think I've seen a marketplace that's been down, was down 20% on a year-to-date basis. If you look at the year-to-date basis, don't worry, it's only down 13% year-to-date right now. And the Skew is extremely low. The VIX has actually come off, but like VIX, let me just show you right now. VIX is still, that's a warning shot across the bow. It's no, still in the 25 region, which is considerable. There's no question about, like, VIX remains relatively high. But again, it doesn't feel like there's any hedging activity to the downside. Does that mean the professional trading world just doesn't believe that we're going to go lower? Okay, because if that's true, it still leaves them exposed to the downside. Because all you have to do is get one, egregious piece of news, and no news is good news with Gary News. You get one piece of heavy news though that comes out like next week, and we're going to get pummeled. And at that point, then they're going to buy puts. And if they buy puts, then it's going to just drive the market down because it's going to flip over everybody's delta risk. It's going to be hideous. It's one of the reasons I don't like. I mean, what does that amount to? I don't like the extremely low skew. I don't like a low, VVIX. And again, there is a monstrous, I was talking about this in kind of the beginning of the video, there's a monstrous, if you will, contango. That is the 18-day volatility futures versus 53-day volatility futures. Like the 18-day are way lower than the 53. It's kind of like everybody's waving a flag. It's okay. It's okay. It's all going to be okay. It's not going to be okay because if we go down from here, professional firms are going to have to buy puts. Professional firms buy puts. Somebody's got to sell them to them. The market makers are selling the puts, but then the market makers are going to have to go out and just smoke the S&P futures. How do you position for all of this? All right, let's talk about positioning moving forward. Okay, energy. Can't stand it at this level. Listen, I'm not here to tell you that oil's going up or down. Okay, that's not my intent. What I am intent on doing though is I am in a short position inside of the energy sector right now. I have been lovingly run over by this. Just the last couple of weeks I've been run over. But do you realize that the energy sector is up almost 55% in a year-to-date basis? That if this thing wasn't up, I mean, the S&Ps would look really, really ugly. Crazy enough, there's a lot of portfolios that don't have energy stocks in them that are getting killed right now because they don't have energy stocks in them. Anyway, energy is up almost 55% year-to-date basis. But we're looking at, like, for instance, GDP print came out. That's actually the second print of first quarter GDP came out this week, showing a contraction. If there's a contraction of growth here in the U.S. or around the world, how come we're not actually seeing it in the energy sector? All right, it's a Russian oil, it's this, that's great. Okay, hey, I got it. Like, believe me. All right, but energy, it has been ripping. Okay, it has been non-stop. There's like a windfall tax going on over in parts of Europe on the energy sector. This has just been, it's unimpeded at this point in time. I would actually look for a little bit of a short position in there. Anyway, I have a number of short positions, but I'm actually going to look to kind of ante up a little bit and some in-out spreads and so forth, some short positions inside of the energy sector. Moving on, yield curve trade. There's another thing that I am absolutely dead set on over here, and that happens to be with the yield curve. For those of you that do not understand yield curve and so forth, I'm actually going to take you over to futures market, and we're going to go look at small exchange. Small exchange actually has futures contracts where you can directly trade like 2-year, okay, and 10-year. It's probably one of the coolest products because what this product base allows you to do is if you look at like the 2-year, and the 2-year is trading at 2.5%, you're like, where are you getting that? Right here. Okay, the last price says 25, so that's 2.5% on the 2-year. And then you look at the 10-year, okay, which is 2.75%. I'm going to tell you my exact trade. My exact trade is going to be, all right, long in the 2-year, okay, short in the 10-year. All right, I'm actually going to trade the 2 versus the 10, looking for the 2-year to actually eclipse the 10. At this point, okay, what are they? All right, they're about a quarter point apart. I would actually look for the 2-year to eclipse over the 10-year in the weeks and months to come. That we're actually going to see once again inversion of the yield curve, because that trade is kind of mellowed out a little bit, and I just think that the yield curve steepened. The yield curve actually should start to flip back over. In terms of other positions over here, another area of the rally I'm looking to fade. XLF, take a look at the XLF. The move inside of the XLF to the upside is absolutely astounding. And I'm going to look for a short position inside of the XLF. But one of the first things I'm going to do is I'm going to wait and see what the S&P futures do. If by chance they get to 42.11, I'm actually going to wait for them to actually hit that 42.11 in the S&P futures, and then actually step in and short some of the financials. Again, make no two ways about it. I still think that there could be some upside opportunity inside of the S&Ps. Maybe I didn't denote that, but again, that 42.11, Okay, we should be a magnet into that thing. Come on into Tuesday. Obviously, Memorial Day is Monday. It's a holiday. Markets are effectively closed. But coming into Tuesday, trading up to 42.11 or the day after that makes a whole lot of sense for this marketplace. Last trade opportunity that I would look at happens to be inside of the dollar. The dollar, also a small exchange product. I like it. In small exchange now listing, of course, options on their futures contracts. I am maintaining a short position inside of the dollar. If you're a little bit more comfortable looking at the dollar in other terms, okay. So we were long dollar for a considerable period of time. We actually flipped over the position short dollar. At this point in time, I would look for a short dollar. I'll reassess when the dollar, and this is the U.S. dollar, U.S. index. This is $ DXY. When this gets under 100 is when I would probably start to reassess that particular trade. So last but definitely not least, as we do each and every weekend update, SPX, the SPX expected move. So as I said, last week had a $126 move priced in. Again, that's $126 higher, $126 lower, right? So that's a 126 move, last week. What do? We did 2 times that, and that's critically important. To go 2 times the expected move is incredible. So one of the things that you have to gather about this next week of trade, the next week of trade only encompasses 4 trading sessions. That's right. You've only got 4 trading sessions. Monday, we are closed. So in 4 trading sessions, what are we looking for? Plus or minus precisely $100 move. To be really specific, it's $100.19. $100 higher, $100 lower. One of the things, though, that's kind of astounding about this $100 expected move in the future week is the S&P has moved $100 when? On Friday. Okay. Again, it's pretty shocking. And then, even the S&P futures moved even further than that in after hours. So one of the things that I caution you, I really do, I give you a caution on this. Don't try to just sell options premium, hoping that we stay in this weekly range. Like, again, we can explode back to the upside over here, which would be, all the way up. Again, that upper edge of the expected move is like 42.60-ish. But we explode back to the upside. Yeah, unequivocally. I would look for a couple of opportunities. Again, we're dangerous right now above the 42.11. If we start to break to the upper edge of the expected move inside of the SPX, that's already taken us above this 42.11. But we're dangerous above 42.11 because above 42.11, you could actually really start to see some people actually come in and try to buy this market back up. At this point, listen, I think it's futility. I think it's way early inside of the process. Anybody looking for, that was it, baby, that was the bottom? Could be, okay? Listen, no one has a feel for what that's going to look like. No one has a feel for what the Fed is going to do, okay? What crisis lies next inside of the marketplace? Again, I think that the yield curve is going to invert again. Energy prices, though, keep an eye on them the next couple of weeks because you got a market right now, as I said, filled with conflict and chaos. This is what trade is about. This is actually a good thing. Volatility is an excellent thing. Take a little breather as we rally back up and get ready to reload because to me, this is a quintessential, okay, bear market rally. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.